Thank you.
Jack has agreed to take some questions. So I have a microphone here, and
I have two questions. First, what is the effect of high-frequency trading on index investors? And what happens if everyone becomes an index investor?
Okay, two good questions. I think you can all hear them. It's about indexing. The effect of high-frequency trading on index investors is essentially zero, because high-frequency trading, or I think Shakespeare said it pretty well, like a tale told by an idiot, full of sound and fury, signifying nothing. They make a big difference in a day, but indexers buy stocks and hold them forever. So they're a diversion. And the stock market, as I've often written, is a diversion to is a serious distraction from the stock market is a serious distraction from the business of investing. All these things that happen don't have anything to do with fundamentals. They will be forgotten pretty quickly. And what you have to do is not let those momentary disturbances affect the way you're thinking and investing, no matter how painful that may be to do. What would happen if everybody invested was the second question. If everybody invested in indexing, we would have catastrophic chaos. There would be no liquidity. You wouldn't be able to buy and sell your stocks. There'd be no way to establish value. And the whole financial system, flawed as it may be, would vanish and fall to nothing. So I have to ask your question two. What is the possibility everybody will index? And I think the answer to that is zero. Right now, about 20% of all equities are held by index funds. And I don't see any problem if you've got the 30 or 40 or 50%, if you want to look at this, and this is slightly oversimplified from a mathematics standpoint. But if the amount in index fund, if the turnover in the stock market today is, leaving aside the high-frequently traders, is something like 150%, I think fairly stated, 150%. If half of the market were indexing, the turnover would be 75%, okay? Because half of the market would be, in effect, immobilized. I don't have any problem with that. In fact, the turnover of the stock market was, when I came into this business, was about 25% a year, way back in 1951. So I don't see any harm that comes. I see much more harm being done by all this frantic activity than is done by having a little less liquidity.
So you said that we need better corporate governance. How do we go about doing that? Is it just more shareholder vigilance, or is there something about the structure of corporate governance that needs to change?
Well, I think it's both. First, we do need we have to change the way institutional investors look at governance. Basically, they look at it as a cost, a distraction, a free ride. I'm spending my money to get the company fixed up. I'm sending people over there and raising heck and all that, and analyzing the company. That all costs money. And if I own 1% of the stock and I'm successful, I get 1% of the value, having put in 100% of the cost. I think that's kind of a sham issue. And if it is a real issue, I proposed many years ago that we have what I call a federation of long-term investors, where we pool our resources to do the analysis. Largely the index funds would do that. So the other part of it is the client conflict of interest that I mentioned. A number of companies, including Vanguard, is running IBM pension money. And no matter what anybody tells you, the highlight of each of our days is not, let's see how we can go out and offend IBM. Just not the way the world works. Now, everybody's going to tell you we don't pay any attention to that when we vote their proxies. And that may be true, although I think it's something that's really a good bit more subtle than some like direct thing. And the fact of the matter is that index funds have done a poorer than normal job, poorer than industry standard job in voting their proxies, which surprises me greatly because they should be the answer to this question. They're the only long-term investors out there. But the fact is that all of us do a bad job on all of it, whether they're clients of us or not. We just don't participate. So when we don't participate in voting in a client controversial situation, it's just what we do with everybody else. And it's also, I think, simply put, the mutual fund business has turned into a great marketing business. Not a great one, but a great big one. And there's no marketing value in controversy. There's no, if you say, well, I'm going to vote against this or that, and it's in the Wall Street Journal, you probably offend half of your shareholders and delight half of them. And that's not a good way to stay in business. So commercial interests get in that. How do we get out of that? Well, there are two ways of doing it. One is what I call the Adam Smith solution. Somebody is going to be an activist in our industry, and a lot of money will flow to that firm if they do it right. In other words, they will be a good firm to invest with if they're trying to make sure the stocks in their portfolio have good managements. And that will take a long time, and time is money in this business. Remember those compound interest examples I gave you. So I regard that as a possible solution, but one that's far too slow for me. So it's that, in that when I said, and I perhaps should have expanded on that a little bit in my prepared remarks, but to get this fiduciary standard, I believe we need a federal fiduciary duty statute, and not one that has a whole lot of detail in it, but one that says essentially what I said about fiduciaries: responsibility for analysis, responsibility to eliminate conflict of interest, responsible to assume the rights and responsibilities of corporate voting, responsible to invest for the long term instead of speculating for the short term, and lay out those principles which are, would eventually develop under sort of a common law concept like they have done in England. Fiduciary duty goes back in England, I guess, 8 centuries or something like that, the idea of fiduciary duty, and just accretes with various legal decisions. It's going to be so hard to do. And of all the people I've talked to about it, I haven't found anyone yet that liked the idea. But I don't think we should say, well, nobody likes it, so I'll think of another one. It's a good idea, and there's at least a possibility that we can kind of make gradual inroads in creating a federal standard of fiduciary duty for money managers. Probably easier to do because we compartmentalize it all. Easier to do with mutual fund managers than pension managers. But since we're all doing both, by the way, there's almost no mutual fund manager that doesn't run pension money, and almost no pension manager that doesn't run mutual money, all on varying proportions. So it's not going to be easy to do, but those would be the outlines of what I would like to see happen.